He's come to IFPA several times. He's Mr. Vetri Subramaniam, CEO from UTI AMC. He is going to speak on managing the wealth creation journey. He has over 30 years of experience in fund management. His previous stints were in Invesco AMC, Kotak Mahindra, Sharekhan and Motilal FS. He is a graduate from Loyola College and PGDM from IIM Bangalore. He is a frequent contributor to articles and interviews to media and educational institutions. Over to you, Mr. Vetri.
Vanakkam. I was saying Vanakkam Chennai, then I was told that there are people who have come from Salem, from Vellore, from Madurai. So I have to say Vanakkam to everybody who has come from Tamil Nadu or beyond. So delighted to be here. Actually, I remember coming, I think, to a IFPA event more than once. So maybe iduvariku rendu vaati vandirken to IFPA event. So it has always been interesting to come to these events and talk to this audience. I was just, it just occurred to me that the previous speaker was called Vijay and my name is Vetri. So we share the name. Normally whenever I travel in most places other than Tamil Nadu, when I say Vetri, then most people say, oh, you're Christian. So I said, no, it's a Tamil word. So then they say, but what does it mean? So then I tell them, you just think of it as Vijay. So then they all nod, okay. So Vetri is same as Vijay. So that's how I explain my name to most people who are not from Tamil Nadu. So today, now I get very scared when people ring the bell. So how many minutes you want me to speak for? 25 minutes, okay, I'll remember that. So today what I'm going to talk about is managing the wealth creation journey. Is it visible? These lights are off, okay. So this is what I'm going to talk about. Topic is today if you see the number of folios in MF industry, that's almost about 20 crore. Unique PAN numbers, they say it's about 5 crore. And the 5 crore number, actually almost half, maybe 60% have all come literally in the last 5 to 6 years. Right? So most people have come in the last 5 to 6 years. Adnala, they have not experienced the stock market the way somebody like me who has been here for more than 30 years has experienced the stock market. Now, inga ninnite stock market pati pesitundana, that means it has been very rewarding journey for me. It has been very rewarding journey for most people who have been in the stock market for 20 years and 30 years. There is nothing new about the stock market being a rewarding place or a great place where ninga wealth create panla for your own needs in the future. Stock market and equities are one of the best investment classes. And the journey la volatility neriya varum. In the last 3-4 years la people have not experienced volatility. Adnala avangalukku theriyadu. Idu madri volatility nu undu markets la, it's not so simple. Most people when I talk to younger people, some are my age of my older daughter, which is about 25, some are slightly older than her. Avangalla illa na invest pannittu 30 la na retire panna poren solranga. I don't know if that is possible. I wish them luck. And stock market is not a place where it is designed to allow you to achieve retirement very early. Stock market is a place where you put your savings so that over 15-20 years it will grow into a large amount of money. You should have a profession, a job, something that you enjoy doing or something you are doing because you can earn income from it. Stock market does not generate income for you. It is a place where your capital can compound, but not which is supposed to give you salary every day. Unfortunately, the only people who get salary every day from the stock market are people like me. In a company which is earning from the stock market. But stock market directly does not pay salary to anybody. So it is important to remember how to manage this wealth creation journey. In the wealth creation journey, if you see of the Indian stock market, I find it very strange when people say this is the golden era. Then I keep thinking, what about my own experience of the last 20 years? Idu kuda golden era da. Idhula enna kammi. And the return paranga 15% over 20 years. So I don't understand why people say suddenly this is a golden era. According to me, last 20 years were also golden era. And next 20 years may also be a golden era. There is nothing new about the ability to create long-term wealth by investing in equities. Nothing new about it. It has been there for many years. Idhila enna true na, in recent years, many Indians have discovered the beauty of investing in the stock market. Ippo namma responsibility enna na, we have to guide them, we have to handhold them through the journey so that they are able to get the benefit of this wealth creation journey. In the wealth creation journey la volatility vandite irukum. You can see over there. My thumb rule, every 12 to 18 months market falls once by 10%. Every 2 to 3 years it will fall once by 20 to 25%. Every 8 to 10 years it will fall 30 to 40%. And yet you make this kind of money if you are able to stay invested. The stock market is a place which can make you unbelievably rich if you can stay invested. Not just because you wrote one SIP today, you will become rich tomorrow. And the SIP pannite irundanga for 20 years, then you can make lots of money. So that is the important thing to remember. Ipo, in the journey irke, as I said, people think it is only one-way street. Na innike equity market vandana innikilende every day na sambadhichite irukano. I should keep making money. Anybody know this gentleman? Yeah? Best known basketball player? Avanga solradhu paarenga. I have missed more than 9,000 shots in my career. I have lost almost 300 games. 26 times I have been trusted in to take that last shot which can help me win the game, and I missed. And despite all of that, he has still succeeded because he keeps playing the game. He is the most celebrated basketball player ever. Ana avanga story la kuda loss irukku. He does lose games. He's missed the most important last point. And yet, over that career, he is the most successful person. If you think about like that in the stock market, it's the same story. இதுக்கு முன்னாடி ஒரு சார்ட் பார்த்தீங்க, 15% CAGR over 20 years. இந்த சார்ட் பாருங்க. How many times did the market fall from the annual high to the annual low every year for the last 20 years? 21%, 16%, 30%, 13%, 30%, 15%, 59%, 17%, 11%, 25%. I don't want to read it all out, but this is self-evident to you. நீங்கள் ஸ்டாக் மார்க்கெட் equity mutual fund enter பண்ணிட்டு, if you keep both your feet locked over there and remain there, you can make money. But that does not mean that the market will make you money every day, every week, every month. Stock market is not a place where you come to generate income. Stock market is the place where you come to compound your capital over long period of time. That is the most important thing to remember. Just like Michael Jordan, losses are part of his career, phases of correction and drawdowns are part of the journey of any stock market investor. And we have to keep telling our investors this. நம்ம அவங்களுக்கு இதை எக்ஸ்பிளைன் பண்ணலன்னா பேனிக் பண்ணுவாங்க. ஓ, மார்க்கெட் இஸ் டவுன் 10%, என்ன பண்ணும், பைசா எல்லாம் எடுத்துடலாமா, ஓடிடலாமா, பிஃபோர் இட் ஃபால்ஸ் எனிமோர். If we don't explain to them before their journey starts that this can happen, they will panic. நீங்கள் எக்ஸ்பிளைன் பண்ணிங்கன்னா there is a better chance that you will be able to hold the client during that difficult time. The other interesting fact about this, normally if I go anywhere, they will ask, economy எப்படி இருக்கு, corporate earnings எப்படி இருக்கு, stock market எப்படி இருக்கு, இந்த 1, 2, 3 questions will always come. அப்போ நான் என்ன சொல்வேன், இதுதான் 20 yearsல ஆயிருக்கு. I think there is very good reason why it will happen in next 20 years. ஆனால் ஏன் லாஸ்ட் மந்த் இது ஆகல, அது மாதிரி கொஸ்டின் வரும். What to say? So I just want to remind you about one thing. அந்த ரைட் சைடில் பார்த்தீங்கன்னா GDP growth over 20 years is 12.5%. Earnings growth over 20 years is 10.5%. Nifty 50 return over 20 years is 15%. And it's like dividends, it's a TRI number, so and the 2% impact of dividends is also coming. Anna, Volatility பார்த்தீங்கன்னா ஜிடிபியில் கம்மி volatility. Very bad year, 5% growth. Excellent year, 9% growth. Corporate earnings, very bad year, 1% growth. Great year, 40% growth. Stock market பார்த்தீங்கன்னா great year, 100%, bad year, -50. So, the stock market is far more volatile than earnings and than GDP. அது ஏன்னு கேட்டிங்கன்னா stock market exists over here in our heads. And because it exists in our heads, we panic. ஐயோ ட்ரம்ப் எலெக்ஷன் வின் பண்ணிட்டாரு, இது நல்லதா பேடா? லாஸ்ட் 2 days மோஸ்ட் இம்பார்ட்டன்ட் கொஸ்டின், மகாராஷ்டிரா எலெக்ஷனில் என்ன ஆகும், அதுக்கு என்ன ரிசல்ட் ஆகும், எனக்கு என்ன தெரியும்? In my life, 30 years in the market, governments have come, governments have gone, wars have happened, wars have not happened, liberalization has happened, privatization has happened, then it has not happened, then it has not happened. All of this is part of the journey of a nation. As long as we are able to continuously move forward, eventually you are able to make returns. So, most important thing, investors find participation in that wealth creation journey difficult because of volatility, and the volatility is not in the corporate sector or in GDP, it is actually in the stock market, because stock market reflects sentiment, greed, fear. When you are making money, you want to invest more and more money. When you are making money, you are not happy that you are making money. You know why? நான் இவ்வளோ சம்பாதிச்சா அவன் என்ன அதிகமாக சம்பாதிச்சிட்டானே, நீங்கள் தப்பான ஃபண்ட் கொடுத்துருக்கீங்க எனக்கு, ரைட்? அண்ட் வென் இட் இஸ் கோயிங் டவுன், நீங்கள் ஏன் மியூச்சுவல் ஃபண்ட் கொடுத்தீங்க, நான் எஃப்டிலேயே போட்டிருப்பேனே. So you can never be happy. Either you are unhappy because somebody is making more money than you, or you are unhappy because you invested in the first place. So that is the volatility that we have to tackle in our mind. I don't want to spend too much time on this. I think even Vijay talked about the same thing. All of you are very well aware, different asset classes have different profiles in terms of return and in terms of risk. Most of the time people are only focused on that return word, and the risk word marandidranga. But risk is also important. Like I have been saying for last few months, in the current market environment, risk is more important than return. I am more focused on managing the risk than I am focused on managing the return. Risk and return of asset classes is different. Inga equity kamchirkom, fixed income kamchirkom. Obviously returns are better, but if you look at standard deviation, it is much higher for equity. Adnala, when you think about the client or the investor's well-being, the more asset classes which are there in the portfolio, the volatility comes down. And the volatility come aichna, and the mind la avanga disturbance kammi aidum. Ippo enna avudana, investor ungala கூப்பிடுறாரு, என் நேபரோட ஃபண்டு என்னோட ஃபண்டோட பெட்டராக பண்ணுது. When market comes down over 1 year, 2 years, like I have experienced many times in your career, அவங்க ஃபோன் வராது, நீங்கள் அவங்கள ஃபோன் பண்ணுவீங்க, அவங்க ஃபோனை எடுக்க மாட்டாங்க. ஐயோ அவன் கூப்பிட்டுட்டாம்பா, எதுக்கு ஃபோன் எடுக்கணும்? So these are all part and parcel. So we have to be aware that the more diversified we get the investor, across strategies, across market cap, across sectors, across asset classes, you can reduce the volatility and improve the journey. Again, this is the same point, so I won't waste time on this. Asset allocation just gives you better risk-adjusted returns. This is the other important thing to remember. See, what I told you, what is important is the journey. What is important is that நீங்கள் அந்த எல்லா ஜர்னி இருக்க ஸ்டார்ட்லேருந்து எண்டு வரைக்கும், you have to be there for the full journey. You can't come only for half journey. The other beautiful thing about diversification across asset classes is that the response from asset classes is very different when big events happen. என்னோட எக்ஸ்பீரியன்ஸில் I will say the big events are not so important, but the big events create volatility. அந்த கிளைண்ட்டு அந்த மோமெண்ட்டில் வாலட்டிலிட்டி தாங்கணும்னா த டைவர்சிஃபிகேஷன் அக்ராஸ் அசெட் கிளாஸஸ் இஸ் வெரி யூஸ்ஃபுல். இங்கே என்ன பண்ணியிருக்கோம்னா, we have just shown various periods. Tech bubble meltdown 2000 to 2003. During that time, equity negative, fixed income positive, and gold, which is the yellow bar, slightly positive. Then you come to something like GFC, which is episode 3. Equity is hugely negative, fixed income positive, gold extremely positive. So what you can see over here, very simply, is that the more asset classes somebody has in the portfolio, the more resilient the portfolio becomes to shock events. I am not saying shock events don't matter. They matter. But they cannot be tackled by saying, இப்போ ட்ரம்ப் எலெக்ஷன் வின் பண்ண போறாருன்னா நீங்கள் போர்ட்ஃபோலியோ எப்படி சேஞ்ச் பண்ணுவாங்க? எனக்கு எப்படி தெரியும்? அவன் என்ன பண்ண போறான்னா அவனுக்கே தெரியாது. Right? So the only way I can manage this is by saying I am not fully exposed to US equity. I am not fully exposed to equity. So I can tolerate the risk. So this is the beauty of diversification. I am from the mutual fund side, so I have only shown equity, gold and fixed income here. But I believe that there is room for many more asset classes in investor portfolio. Obviously one big one which we don't show here is real estate. But that also has a place in giving that investor the benefit of managing event risk. So that is also important. This is again, I think, one point which is very underappreciated. In the investing journey, everybody is only focused on maximization. Yedhula best return kedukum, yedhula I can prove that I am smarter than somebody else, I can prove that I can make more money than somebody else. But in investment, what is underrated is survival. Your ability to manage difficult periods is what makes all the difference. நீங்கள் உங்கள் லைஃப் கூட பார்த்துருங்க, உங்கள் கரியர் பாருங்க, there have always been some difficult periods. How you manage that difficult period determines how you will emerge on the other side. That is exactly what these gentlemen are saying over here. And particularly I find Kumar Mangalam Birla's idea very useful. If you survive the difficult period, அதுக்கப்புறம் ஒரு ரேஸ் திருப்பியும் வரும், நீங்கள் தான் ஸ்டார்ட் லைனில் இருப்பீங்க. Those who could not manage that difficult period will not even be competing with you. And this we see time and again in industry after industry. The strong people survive the difficult times. When the next race starts, they are already there, ready to start. The weak hands have been removed. So this is very important even as an investor. That is why, to my mind, and the volatility manage pannunona, that diversification becomes important across asset classes and across different metrics of evaluation, because survival is important. Your outcome in life will be determined by how you did in your investing between the time you were maybe 20 to 23. அப்பதான் உங்க earning start ஆகும், and maybe your earning will go on up to the age of 50, 60. Supreme Court lawyers maybe 70, 75. But that is what will determine your outcome. Right? It is the survival ability to manage those difficult times. So this is important to remember. Compounding is not a wealth maximization function, it is a wealth optimization function. Right? And I just want to shift to another gentleman whom I hugely admire, because I've learned a lot from him when it comes to investing. Funny thing is, he actually invests distressed debt. He doesn't invest in equity. Howard Marks. Ninga in the book padikkalana, it is your loss. Please read this book. The most important thing. By the way, I should warn you, there is no one important thing in this book. Every chapter starts by saying the most important thing. So there are many important things in investing, and all of them are covered in this book. Our memo memo pere the most important thing. That's how he has named the book. Now this is important to remember, because this line is important. There is no such thing as a good or bad idea regardless of price. And that price word irke, just replace it in your head with the word valuation. There is no such thing as a good idea or a bad idea if you ignore the valuation. Valuation eventually matters. Valuation will eventually have an impact on what your outcomes are. அது நீங்கள் எப்படி மேனேஜ் பண்ண போகிறீங்க? One simple way is, if you keep doing SIP, to some extent it doesn't matter, because some days you will buy the market expensive, some days you will buy it cheap, adella average aidum. And when you need to remove the money, nowadays I tell people, use SWP. Some days you will withdraw when it is expensive, some days you will withdraw when it is cheap. Again, it doesn't matter, because in between the compounding function was 15 to 18%, so your problem is taken care of. But sometimes valuations are important and they cannot be ignored. and sometimes you will therefore have to rebalance your portfolio. Just a simple example of why valuation matters. இதில் ஒரு ரொம்ப சிம்பிளாக பண்ணியிருக்கோம். 2008 to 2024 monthly data. Every time you bought the market when the Nifty PE multiple was below 20 and when it was greater than 20. You can see the difference yourself. But this is a principle of life. Has anybody gone to Amazon when Amazon says today I am going to charge extra price? No, na. Only when they say Republic Day sale, appada neenga porenga illaya, yen porenga, ena price is low. Same logic works even in the stock market. When the valuation is low, you get better return, better 1 year return, better 2 year return, better 3 year return, better 5 year return. Actually, there is a secret trick sitting over here. Even if you pick a lousy fund manager, if you pick the cheap market, your returns will be better. You see this? So, my simple point is valuations eventually do matter. They cannot be ignored. SIP, SWP, okay, doesn't matter so much. And then lump sum panna porengana, please pay some attention to where is the valuation. You cannot get carried away with what I call as narratives. Because look at that gap. 5-year return, these are averages, the gap is 3%. If I were to underperform by 3%, you will fire me. Useless fund manager underperforming by 3%. By investing at a higher price, you have underperformed by 3%. So this is the alpha you can create. This is not my alpha, this is your alpha. You are the advisor. That is how you will prove your value to the client. So please keep this in mind. And this is obviously, visible across all data sets. These days, I see lots of these narratives. Today, India is like this. After 20 years, it will become like that. Therefore, you must invest. But price is not important. So let me give you a simple example. This is a book by Václav Smil, a fantastic author if you want to read any of his books. And this was quoted by Bill Gates in his blog. China used more cement in 3 years, 2011 to 2013, that the US used in one entire century, which is 1901 to 2000. So based on this, do you think we can make money by buying cement? Huh? Let me show you the outcome. This is a cement company called Anhui Conch, one of China's largest cement companies. The peak came in 2007. After that also you made some money, but you would have made more money by putting money in a fixed deposit even in China. And the reason you did not make money is look at those valuations, 10 times book for a cement company. So consumption 3 years was equal to 100 years of consumption of US. Pay the wrong price, you can't make money. And let me give you an even simpler example. Anybody remember Infosys? Right? Between 2000 and 2010, profits went up 37% CAGR, revenue went up 38% CAGR. Anybody know what is the stock price return? 9.7%. If something is priced wrong, you will suffer from that in terms of your returns. If something is a lousy business, the outcome will be even worse. Capital will get wiped out. நீங்கள் போயிட்டு பாருங்க 2008 என்னெல்லாம் கம்பெனி நிஃப்டியில் இருந்தது, அந்த கம்பெனி எல்லாம் இன்னைக்கு they are bankrupt, they don't exist. Lanco, GMR, GVK does exist but much smaller scale. Reliance Communication. So bankruptcy is a complete wipeout, but even overpriced stock, it can be painful. So eventually this is the one idea I want to leave you with. Please don't invest on the basis that if I invest today, I should get my satisfaction tomorrow. This is a wonderful statement by Jim Grant. Successful investing is having everybody agree with you, not today when you buy. Today when you buy, you want more people to disagree with you because the asset will be cheaper. You want them to agree with you later. Because after you have bought, if they agree with you later, the asset will be priced more expensively. That's how you improve your returns. And that is what is this example which is known as the marshmallow test, where they put children in a room and put a camera on them. And they made them sit at a chair and they put a plate and they put what they call a marshmallow. And they said, you can eat this marshmallow, we'll come back in some time. If you don't eat the marshmallow, we'll give you 2. And this is the child who's going crazy saying, should I eat it or should I wait? And they found in the marshmallow test that those who could wait, their ability to navigate life was actually far better than those who were unable to wait. So we have to learn this habit in our investing life, that can we learn to be patient. Just one more point, pretty much sort of my final point before I go to the summation. Everybody, as I said, is focused on picking the best strategy. But what about staying with the best strategy? This is Mr. Warren Buffett. 1998 to 1999, the stock dropped 28%. S&P 500 was up 32%. Nasdaq was up 177%. Useless fund manager, fire him, remove all the money. What happens in the next 2 years? Berkshire Hathaway went up 25%, S&P was down 28%, Nasdaq lost 68%. Do the math. Who was better at the end of those 4 years? It's not just about picking who has the momentum today, it's about who can stay the course. And you have to stay the course as well. I won't read this out, this is basically just a summary slide. These are all the points that I already made. Equities are the best, drawdowns are part of the journey, equities are more volatile, asset allocation is important, valuations are important, don't fall for narratives, please look at valuations. Investing is your ability to delay gratification, please be patient. The last one I want to leave you is, please learn to say no. See, beyond a point, I must admit, we are all manufacturers. It is our job to keep bringing new products. But please, you have a responsibility on the other side to your client. You have to figure out when you will say no to my products. Because if you don't say no to any product and you buy every product, eventually your customer's fund portfolio will look like the Nifty 50. Maybe it will look like Nifty 500. One fund you can calculate. See, I gave you this fund here, from here to here it did better. This fund I gave you here, from here to here it did better. And the 20-year when you do the calculation, you will figure out that put together he did exactly better, or he did exactly equal, most probably did worse than Nifty 500. So please remember this, you cannot buy every product that comes your way. Learning to say no to some products is equally important. Already Jaishankar is giving me dirty glares. He's saying, how can you tell people to say no to products? But somewhere you will have to exercise that restraint. So this is the last point I want to leave you with. Sometimes learn to say no as well. It's important. If you give your customer 30 or 40 funds in their portfolio, below those 30 funds are 300 to 400 companies. I guarantee you in the lifetime that person cannot earn more than the Nifty 500. It will be exactly equal to that. Then why you went to active fund managers? So if you come to active fund managers, you will have to pick and you will have to stay the journey. Thank you so much. That was my time.